The currency pairs that our team will be analysing is Australian dollar to United States dollar, as well as United States dollar to Japanese yen. Relative interest rates, relative inflation rates, and relative growth rates are the economic indicators that will be used to analyse the exchange rates discussed. First, we'll be analysing the Australian dollar to the United States dollar.
We will now be discussing the impact of interest rates on the current exchange rate. If Australia has higher interest rates than the United States, it will experience less demand for exports and therefore less demand for AUD, more demand for imports and therefore more supply of the AUD. As you can observe from the following graph, in regards to the result in the exchange rate, a rise in interest rates would result in an increase in the demand for imports due to the fact that it is more expensive to borrow money locally, causing people to spend offshore and creating a higher supply of the currency, hence a reduction in the exchange rate. In reference to tradingeconomics.com, although over the period of the last year the Australian interest rate has been constant at 1.5%, it is predicted that by 2019 the cash rate will increase by 1% and another by 2020. Whilst the USA's cash rate has risen fairly rapidly over the last year and has currently overtaken our current rate by 0.3%, it is predicted that by the end of 2018 and leading into 2019, the interest rate will continue to rise. This can support the statement that over the next 3 to 6 months, the US dollar will depreciate against the Australian dollar, as indicated by the recent patterns in interest rates between the two countries.
According to Travelex, the Australian dollar to US dollar currency is around 0.75. That means 1 Australian dollar is worth 75 US cents. If you flip it the other way, the US dollar to Australian dollar rate is 1.25. That means 1 US dollar is worth $1.25 in Australian dollars. As you can observe from the following graph, if Australia has higher inflation than the United States, it will experience less demand for exports and therefore less demand for Australian dollar, and more demand for imports and therefore more supply of the Australian dollar. It can be observed in the following inflation chart that consumer prices in Australia rose 1.9% in December of 2017. This is the result of alcohol, housing, as well as other factors. The inflation rate in the United States increased 2.4% in March of 2018. United States higher inflation depreciates its currency as these goods will cost more for other nations to purchase. It can then be observed that the United States inflation rate is the highest rate in a year. Therefore, it can be predicted that in the next 3 to 6 months, if these factors continue to increase, the United States dollar would be expected to depreciate against the Australian dollar.
We will now look at relative growth rates. If Australia has an increasing relative growth rate to the US, there will be an increase in the supply of the Australian dollar as imports decrease. An increase in overseas borrowing will cause an increase in demand for the Australian dollar. If Australia's growth increases at a higher rate than trading partners such as the US, the income and aggregate demand is likely to increase. Thus, the demand for imported goods and services will be increasing at a faster rate. This causes an increase in the supply of the Australian dollar, as shown by the shift from S1 to S2. Conversely, when investing is occurring through offshore companies that are Australian-owned, the capital inflow will cause an increase in demand for the Australian dollar, as shown by the shift from demand 1 to demand 2, and thus a new exchange rate is created. According to the Commonwealth Bank, the Australian economy is expected to grow between 2.5 to 3% over 2018. This is slightly above that of 2017. In the next 3 to 6 months, growth of the economy relative to the US is hard to pinpoint. The RBA take caution in the US political situation becoming restrictive towards trade and what that impact will be on the global growth prospects. It may decrease the demand for imports, which may drop. This could have a flow-on effect and decrease the demand for the Australian dollar in terms of our resources sector as demand drops. However, the RBA state Australian commodities are likely to remain high, thus continuing the demand for the Australian dollar and helping it to potentially appreciate against the USD. In regards to the tariffs, people outside of the US may find it a more risky place to hold money, given the economic policies occurring there at the moment. Thus, it may begin depreciating against the Australian dollar. However, economic growth is hard to pinpoint for the near future.
We will now be comparing the US dollar against the Japanese yen. Again, supported by TradingEconomics.com, the Japanese interest rate is currently at negative 0.1% and is expected to rise very slightly over the next 2 years. Compared to the US cash rate, it is significantly lower, as policymakers have set its 10-year government bond yield target at around 0%. Japan's economy is expanding moderately, with a virtuous cycle from income to spending. Overseas economies have continued to grow firmly on the whole. In this situation, exports have been on an increasing trend. On the domestic demand side, business fixed investment has continued on an increasing trend, with corporate profits and business sentiment improving. This can then lead into the fact that due to the extremely low interest rates and high exports, there will continue to be a high demand of the Japanese yen. Hence, it can be very likely predicted that the Japanese yen will appreciate against the US dollar over the next 3 to 6 months.
According to Travelex, the United States dollar to Japanese yen is around 95.73. That means 1 US dollar is worth 95.73 Japanese yen. If you flip it the other way, the Japanese yen to US dollar rate is 0.0104. That means 1 Japanese yen is worth 0.0104 US cents. As we observed from the Australian dollar to the United States dollar exchange rate, the inflation rate in the United States increased 2.4% in March of 2018. Now looking at the United States dollar to Japanese yen, Japan's inflation rate rose by 1.5% in February of 2018. According to Sam Forgione, in 2018, United States inflation has undermined the dollar's strength by diminishing its spending power. For consecutive periods, inflation for Japan has come in below the 2% target from the Bank of Japan. It can be analyzed that in the up-and-coming months, the United States dollar would be expected to depreciate against the Japanese yen due to US's inflation rate being higher than Japan's, resulting in the US being able to buy less for their dollar.
In regards to the economy, the US has a far stronger growth rate in recent years when compared with Japan, who has been attempting to recover their economy for many years, and thus they obtain to keep a reasonably low value for the yen. Politically, it is likely the yen will continue to remain relatively weak to the US. However, what may cause an impact, as reported by Thomson Reuters, is Trump's trade negotiations with Japan, which may involve talk of Japan deliberately devaluing their yen to help with their exports through weak monetary policy. In regards to the economy, the US has a far stronger growth rate in recent years when compared to Japan, who has been attempting to recover their economy for many years. Thus, they obtain to keep a reasonably low value for the yen. Politically, it is likely that the yen will continue to remain relatively weak to the US. However, what may cause an impact, as reported by Thomson Reuters, is President Trump's trade negotiations with Japan, which may involve talk of Japan deliberately devaluing their yen to help export with the weak monetary policy. As shown in the graph below, the low yen relative to the USD causes an increasing demand, thus shifting the curve to the right, with export demand continuing on an upward trend. However, this is likely outweighed by the increased supply from government intervention in Japan, thus the shift of the supply curve to S2, continuing to keep the yen low. Likely the USD will continue to appreciate against the yen in these trade negotiations in the oncoming months.